Hello, everyone. This is Gilbert Gelada. I'm talking to you here from Private Corporate Counsel, downtown Orlando. This is Tufts on Tax, where all your tax issues and questions are right here with Mr. T. Scott Tufts. You can call him at 877-647-7887 or the same number, which is 407-647-7887. You can reach him also via email at stufts@pcc.law. That's STUFTS at pcc.law, or visit the website at privatecorporatecounsel.com. Please like and share and save that video so you can have more episodes and more information and content from T. Scott Tufts on Tufts on Tax. Hello, Scott. How are you?
Hey, good to be with you.
Good to be with you too. A new episode and a new case today. We have Maggard or Maggard. Hopefully I'm saying it correctly. Maggard case today.
Mm-hmm. That's right.
What is that all about, and what does it entail?
So we are talking about a tax court case, August 7th, out of the tax court, August 7th, 2024. The case is very interesting to our business owners out there who operate as S corp. So remember. If you can be an LLC and make an S corporation election, or you can be a corporation making an S corporation election. And for our audience that knows what it's like to be an S corporation and are familiar with it, you know that you have to treat everything pro rata, meaning that if you're 50-50, then you've got to distribute everything 50-50. You can't have a preferred return. That type thing. You cannot prioritize and move things around with flexibility or as much flexibility. And therefore, they have rules and restrictions that make people nervous when they operate as an S corporation. And again, it could be an LLC, which is not a corporation. It's a limited liability company that can make an election to be an S corporation. So it gets confusing. You're a member, but for tax purposes, you're a shareholder. It gets, folks got to understand the when the state law goes different than tax law. But anyway, so Maggard is an entrepreneur who co-founded an engineering firm, and when his co-partner left, or when one of the original partners left, he took on two friends as co-owners. And what he alleges they did was, and they got into litigation, he says that they took all the money out of the business and looted, as he said, the business, and he didn't get any money. And yet he alleges that the IRS comes in and sticks him with the tax bill on his proportionate share.
How long has he been in business?
So he was in business in the Silicon Valley community that they started and were operating roughly at the beginning of the century in 2000, 2001, 2002. And so they incorporated the company in California. Oh, wow. They elected to be taxed as an S corporation, and they don't change that election. And all the way through 2016 is when some things happen. And so the court gets involved. And, one of the things that is most interesting about this case is that when you bring and have partners, or in this case, shareholders operating in a percentage. So in this case, Maggard had 40% of the company, and another shareholder had 40%, and another one had 20%. So you had 60% and 40%. Okay. Now, under the company's governing documents, that would be like your articles and your bylaws, right? And your agreements with the shareholders. You look at all of that. The question is, under those agreements, they were entitled to a proportionate share of the distributions, right? So that means that if you're 40-40-20, right, you should get 40-40-20 split on the distributions. Got it so far?
Yeah.
All right. So the question becomes, what happens, all right, in this case, what happens when you have something change in the way the distributions are occurring? Meaning you have disproportionate distributions. You follow me? So the concern becomes, when you have that, does it create a a blowing of the S corporation election. That's what our business people out there will know about. They always go, I don't want to do something wrong and blow the S election and create a tax catastrophe. Got it? Mm-hmm. So the key here is, and in this case, the tax returns stopped getting filed at a certain point in time, and therefore the K-1s are not then filed. So can you imagine that? So you've got a scenario where the returns are not coming in, right? And you've got a allegation that one of the persons was began to misappropriate funds by inflating reimbursements on expense accounts, and that two of them began a process of making disproportionate distributions of earnings to themselves, but not to Maggard.
Oh my God!
Understand that?
How many partners?
3. Remember we
3.
had 40, 40, 20, right?
Oh, okay.
All right. So when Maggard caught on to this was 2012, he hires a CPA and tries to reconcile the company's books. Make sense? Mm-hmm. And they're looking at, and what the accountant found when they were looking over the books is that they had over distributed an amount, right? Mm-hmm. To one of the shareholders. Got it? And so someone took more than they should. You understand?
Yeah.
All right. So now what do? Right? Well, guess what? This is where you get into litigation, right? Because you're going to say, hey, you owe me money, right? And this is and what happened is 2 of the shareholders froze out the other one, right? They cut him from the company books, cut him out of meetings. This is what he's alleging. And that they prevented Maggard from fully participating as a director and shareholder, which he was by these governing documents required to be an equal participant in. Got it? Mm. So the majority picked on the lesser shareholder. Got it? Mm. And therefore you got that issue going on. All right. Now, added to that is you've got the problem of how does that litigation play out? So guess what? So 2 of them sue Maggard in California court. Okay. Mm-hmm. And they sue him for breach of contract and fraud, injunctive relief in the form of his employment contract, as well as declaratory relief. All right. And so they're asserting their 60% position. Got it? Maggard counterclaims, and he seeks a he counterclaims and he seeks a rescission of their deal, fraud and failure consideration conversion, breach of contract and embezzlement, and a declaratory relief judgment to invalidate the shares that the one guy held that took more than he should, and he sues for an accounting. So our folks that know about business disputes and business litigation, this is the kind of stuff that can fly among these kinds of situations. All right. But here's what's critical. The case, all right, plays itself out where they reach the court reaches a decision, okay? And in that decision, it found that the company had over-distributed to one shareholder and under-distributed to the other. Got it? Mm. And it said that because it hadn't done that correctly, right, mm-hmm. That there was no authorization for these disproportionate distributions. Got it? And therefore, because he wasn't aware of it and so forth, then the judgment of the decision was that the company was to make a corrective distribution to him. So he vindicates his position by going to court, right? That's what we want folks to do in that situation.
Correct.
All right. But the other 2 refused to do that, right?
Yeah.
And so they reach a settlement. Okay?
Oh.
So they basically come in and offer to buy him out his percentage interest, right? Mm-hmm. And his 40% stake, right? And they sign a settlement. Okay? Now, here's what's key for our audience. He signs a settlement and they sign a settlement, right? To buy out his interest. In the process of doing so, the settlement agreement says that the company will not make changes to the K-1s that were issued in the year of the settlement for the prior years. Remember what I said?
Yeah.
And this is very important.
The distribution
They said, no, it's not just that, Gilbert. I said that they were not filing tax returns. So remember, we've got no corporate return being filed, no K-1s being issued. Okay.
That's a problem.
Right. And when they go back and file those, they back file those returns, and the K-1s, listen to what they're doing. They're back filing them, and they say they said no one's going to change them.
Oh my God.
And that goes against what we've talked about, which is what about the 8082? Remember the form 8082, Gilbert? K1's 8082. 8082 says, not in my backyard, essentially. What it does is it's the counter to the K1 each and every year that our audience needs to be on top of. If you don't get a K1 and you should have, you file the 8082. Got it? If the K1 is wrong in the four corners of the document, right, you got to file the 8082. It's called a notice of inconsistent treatment, and it basically stops the IRS from just automatically assessing you from what you file. Got it? So here...
So that's not ethical.
Well, it's not so much it's not ethical. It's that if you try and cut that right off because you don't want the uncertainty of someone coming back, then that can hurt your settlement, right?
Yeah.
But the government's not at the settlement table.
Yeah.
Correct?
Correct.
So what the problem you have here is the IRS then comes along, right? And after that all happened, Maggard went to the IRS whistleblower office. Remember, we prior episodes, we've talked about the whistleblower statute, but here's where it gets really interesting. During the litigation, Maggard went to the whistleblower office of the IRS, okay? And he explained that they were making disproportionate distributions. Got it? And that they were not filing the tax returns. Got it? So he's telling them during that process, right? Got it? And so he's being told by the IRS whistleblower office, here's what, is going to happen, or not so much what's going to happen, but he's basically reporting this in some kind of way, okay? He then submits a whistleblower form, all right? And he's claiming that they're taking false deductions, underreported income, failing to pay tax, kickbacks, you name it, and he's putting that all in his filings, okay? Now, what we're getting at the end of the day here is did this disqualify the S corporation? Okay? Because if it did, then you don't get taxed on them. You might not get taxed on those distributions because you're not having to deal with those S corporation rules, pro rata. You understand? So bottom line is the IRS comes in, and the decision that is, I think for our audience, just shocking, is going to be that because there was no effort made, and it says, listen to what the court says. This is a quote from the tax court. We recognize that this can create a serious problem for a taxpayer who winds up on the hook for taxes owed on an S corporation's income without actually receiving his or her just share of its distributions. This is especially problematic when the taxpayer relies on the S corporation distributions to pay these taxes. Worse yet is when a shareholder fails to receive information from the corporation that he needs to accurately report his income. This is what happened to Maggard. It says one cannot help but sympathize. This is what the court says. One cannot help but sympathize with a taxpayer caught in this situation. But it is a situation we've seen before, and they go through some cases where this has happened, all right? And last but not least, they say, and this is kind of important, it says, the law is ironclad on this issue. We find that the company neither authorized nor created a second class of shares by way of formal corporate action. This means that we must hold that the company continue to maintain its S status, and therefore the income that flowed to two but didn't flow to the other one still must be included in his income. So the long and short of this is they take the hardline view that the documents themselves did not allow this to happen. Therefore, this had to be fixed at settlement. You had to fight this, and you have to fight the tax issue in the state court. Got it? You cannot keep them separate from each other and not address them. See what I'm saying?
Yeah.
So bottom line for our audience is this is a big time case because it emphasizes the need when you're in litigation to get those tax issues front and center and resolve them simultaneously if you can. And it might keep you from settling if you've got a tax problem that's, in that mix. So it can be a real mess. And so you try your best to deal with this, but it can make your business settlements and dispute resolution that much harder. And look at your governing documents. You go back to square one, get the advice up front to make sure you're adhering to those S corporation rules. Make sure you know what that means. Make sure you even want to be an S corporation, that kind of thing.
Yes.
So, all right.
You've been always saying that to the audience, to all businesses.
Yep.
Now, are we going to revisit this case again?
Well, the concept we will. We will talk about S corporations in the future. We try and keep our eye on S
which
corporations.
We have in the past.
And we talk about 808 huge, because remember, audience, you've got K1s. Well, the question is, do you at the same time, do you have a problem on the K1? How do you resolve it? Remember what we said, get good advice because you've got to go back up the chain, so to speak, and get the K1 resolved if you can, if it's in error. If there's no K1 issue, but there should have been, that's a whole nother situation where you need to use the 8082 in these situations. And this isn't, but the last thing I'll say, this 8082 is to counter the K1s, right, that are erroneous.
Mm-hmm.
Now, remember, we've got partnerships, IRS Form 1065 that files K1s. The 8082 applies against that. If you look at the 8082 form, it also is to counter the S corporation, which is the Form 1120S, and its K1. It also counters the trusts and estates. So my point is, when you see a K1, if it ain't right, try and fix it. If it's not fixable because they're not willing to do it, whoever gave you the K1, then you're into a situation where you got to seriously know what you're doing when you go to get that 8082 filed. And then you're getting ready for a problem. Because why? If you file an inconsistent treatment, you're notifying the IRS, and now you're going to have a dispute, right? Because people are going to get looked at. It's going to trigger something. Got it?
Yes, you heard him, folks. You can call Mr. T. Scott Tufts at 877-647-7887. Always get the advice. Make sure the correct advice. Check your documents. Again, the number is on a 407-407-647-7887. You can email him also at stufts@pcc.law. That's stufts@pcc.law. Or you can reach him on the website at privatecorporatecounsel.com. Like and share these videos and the podcast so you can receive more and updates on everything we talk about, the content and more on Apple, Spotify, and YouTube. Thank you and have a wonderful day.